It was September 2008, and Wall Street looked like a battlefield without smoke. Traders stared at screens flashing red, numbers plummeting faster than they could type. Phones rang with the urgency of 1,000 alarms, but no one had answers. Outside Lehman Brothers headquarters in Manhattan, employees filed out carrying cardboard boxes, their entire careers reduced to desk trinkets and photos. On that day, the unthinkable had happened. One of the world's largest banks had collapsed, triggering a panic that spread like fire across the globe. But behind this implosion was not just bad luck or a single bank's mistake. It was a trick. A financial trick so seductive and so complex that even seasoned bankers barely understood it. A trick made of contracts called derivatives, financial weapons dressed as safety nets, promises piled on promises until the entire structure collapsed under its own weight. To understand it, imagine a magician's illusion. A man waves his hand and shows you a house, solid and real. But instead of bricks, the walls are stacked from paper contracts, each one saying the house is worth gold. Investors bought those contracts as if they were solid stone. They traded them, bundled them, bet on them. The more layers added, the stronger the illusion appeared. Until one day, the foundation cracked, and the entire house vanished in dust. That illusion nearly destroyed the modern world economy. It all began with something deceptively simple: the American dream of home ownership. For decades, banks handed out mortgages to families who wanted a house with a yard, a roof, a piece of stability. But by the late 1990s and early 2000s, something changed. Wall Street realized those mortgages could be packaged into financial products. One family's mortgage payment, when combined with thousands of others, could become a steady river of cash. And that river could be sold. These packages were called mortgage-backed securities. At first, they were safe, built from loans to solid borrowers, but soon, hunger for profit turned caution into recklessness. Banks began lending to anyone. Low income, unstable jobs, no credit history. Subprime loans, they called them. Risky loans. But no matter. Wall Street had a trick. They bundled good mortgages with bad ones, wrapped them into packages, and sold them to investors around the world. With the stroke of financial engineering, toxic loans looked like golden opportunities. And then came the derivatives. These were contracts that didn't just sell the mortgages. They sold bets on the mortgages. They were called collateralized debt obligations, or CDOs. Imagine stacking layers of promises. One layer said the loans were safe, another said the first layer was safe, and another bet on the layer above. Each layer looked solid, but each depended on the one below. When homeowners started to default, the layers cracked like dominoes. Banks reassured investors with another trick: credit default swaps. These were insurance contracts that promised to pay if mortgages failed. On paper, it looked like safety. In reality, it was gambling. Institutions like AIG sold billions in these swaps, confident that housing prices could never fall nationwide. The illusion grew. The machine roared. Profits soared. By 2006, the U.S. housing market had turned into a casino. Families bought houses they couldn't afford. Banks pushed loans with hidden traps. Wall Street cut and stacked mortgages into ever riskier towers, selling them to pension funds, governments, even ordinary savers. Ratings agencies, meant to be watchdogs, stamped AAAA, the highest grade of safety, on packages filled with poison. Everyone believed. Everyone played along. The magician's illusion looked real, but reality could not be denied forever. Housing prices began to fall. Families missed payments. Foreclosures spread like disease across suburbs. And as one family defaulted, it wasn't just their house at risk, it was an entire chain of financial products stretching across the globe. A default in Ohio meant a pension fund in Norway lost millions. A foreclosure in California meant a German bank faced bankruptcy. The illusion cracked, and the cracks raced through the world economy. By September 2008, the system unraveled. Lehman Brothers collapsed under debt so vast they stunned the world. IIG, once a titan, begged for rescue as it could not cover the insurance it had sold. Banks froze, lending to each other, terrified that no balance sheet was honest. Stock markets plunged, wiping trillions from global wealth. Lines formed outside banks as ordinary people feared their savings would vanish. In those weeks, the global financial system stood on the brink of total collapse. Governments scrambled. Trillions of dollars were poured into rescues, bailouts, emergency loans. Central banks cut interest rates to zero. Ordinary families lost jobs, homes, savings. What had been sold as clever finance revealed itself as reckless greed. And all of it began with a trick, the derivatives trick. A trick that transformed risky loans into golden securities, that disguised gambling as insurance, that turned paper illusions into the foundation of the global economy. And as you're hearing this story, pause for a moment. If you want to continue uncovering these hidden lessons of history, where money, power, and human folly collide, make sure to subscribe. That way you won't miss the next chapter in this series of financial secrets. When Lehman Brothers fell, the shock was not confined to Wall Street. Within hours, banks in London, Paris, Frankfurt, Tokyo all froze their lending. Interbank credit, the invisible bloodstream of global finance, dried up. Without it, even healthy businesses could not function. Overnight, companies couldn't roll over short-term debt. Trucks stopped delivering goods. Retailers couldn't pay suppliers. In cities from Dublin to Detroit, the air grew heavy with panic. The headlines screamed collapse. Stock markets plunged in synchronized chaos. In a single week, the world lost trillions of dollars in wealth on paper. Families watched retirement accounts shrink to half their size. University endowments crumbled. Entire countries teetered on bankruptcy. Iceland's banks failed completely, dragging the nation into financial exile. What began as a trick on American mortgages had now become a contagion infecting the globe. The trick was this. Derivatives made risk look like safety. When one bank bought a CDO, another sold insurance on it, and another borrowed against it. The same mortgage payment in Cleveland or Miami might have been repackaged and sold 10 different ways. So when the payment stopped, it wasn't just one contract that failed. It was dozens. It was chains of promises stretching across continents. Each default lit a fuse that set off explosions far away. In Washington, men in dark suits realized the system could not survive without intervention. The U.S. government unleashed the TARP program, $700 billion to bail out banks. Central banks slashed interest rates, printing money in unprecedented amounts. In London, Gordon Brown's government nationalized banks to keep them alive. In Frankfurt, the European Central Bank injected liquidity to calm the storm. And in capitals worldwide, taxpayers were told, your money must save the very institutions that gambled it away. The outrage was volcanic. Families lost homes in foreclosures, yet banks received lifelines. Millions lost jobs, yet CEOs kept bonuses. On American streets, people carried signs. Banks got bailed out. We got sold out in Spain, in Greece, in Ireland. Unemployment soared. Young graduates found no jobs, mortgages collapsed, entire generations delayed adulthood. The derivatives trick had not just destroyed balance sheets, it had scarred lives. Behind the numbers were stories of heartbreak. A couple in Nevada losing their house after 20 years. A factory worker in Michigan finding the gates locked forever. A retiree in Germany watching her savings vanish from a pension fund invested in CDOS. Ordinary people, far from Wall Street, paid the price for the illusion built on derivatives. The irony was that many of those who designed the trick never faced consequences. Complex contracts shielded them from liability. Governments argued that punishing banks would destroy confidence further. So instead, institutions were stabilized, executives walked away, and the public bore the burden. In the years after 2008, this injustice fed waves of political anger that reshaped nations. populist movements gained strength, fueled by the memory of 2008. But perhaps the deepest wound was psychological. Trust, the fragile foundation of finance, had shattered. If banks could lie, if regulators could look away, if ratings agencies could stamp poison as safe, what could be believed? Money, after all, is not just paper, it is belief. And in 2008, belief cracked. It was as if the world awoke from a dream and realized that prosperity had been built on shadows. And yet, despite the horror, the system survived. The bailouts worked, at least in preventing total collapse. Banks recovered, stock markets rebounded. By 2010, traders were once again celebrating record profits. But beneath the surface, questions lingered. Had the lesson been learned, or had the world merely patched the cracks without changing the foundation? The derivatives market never truly vanished. It shrank, it was regulated, but it endured. Even today, trillions in derivatives circulate, hidden in the ledgers of global banks. The trick has not disappeared, it has only been tamed for now. Looking back, the crisis of 2008 was not just an economic failure, it was a moral one. It revealed how greed can disguise itself as innovation, how illusions can be sold as stability, and how societies can be held hostage by contracts so complex even their creators did not understand them fully. It showed that when risk is hidden long enough, it explodes in ways no one can control. And perhaps that is the final lesson. Derivatives were not evil in themselves, they were tools, contracts of promise. But in the hands of institutions blinded by profit, they became weapons of mass destruction. A single trick multiplied across the globe nearly ended modern finance. The world escaped destruction in 2008, but only barely. And as history reminds us, tricks have a way of returning in new forms. Somewhere in the shadows of today's markets, another illusion may already be taking shape,